Switzerland, a country synonymous with financial neutrality and discretion. For decades, it operated at the center of global finance, trusted by all sides, aligned with none. But right now, Switzerland is facing unprecedented pressure from the United States. Banking secrecy. Not over tax evasion, over gold. 4 of the world's largest gold refineries sit in Switzerland. Together, they process nearly 70% of all newly mined and recycled gold. In recent months, U.S. officials have quietly intensified scrutiny over how these refineries source gold, who they trade with, and where finished bars end up. This isn't a public confrontation. No sanctions, no headlines, just steady pressure through regulatory channels and diplomatic conversations. And here's what makes this significant. This isn't about stopping gold flows. It's about controlling them. The question isn't whether America has the legal authority. The question is why now? What changed in the global gold market that suddenly made Swiss refineries a strategic target? And what does this reveal about gold's future role in a fragmenting financial system? Kevin WARSH, former Federal Reserve Governor, recently made an observation most analysts missed. The real battle isn't over gold prices, it's over gold infrastructure. The physical refineries, certification systems, logistics networks that determine where gold goes and who decides what counts as legitimate. If you think this is just about compliance or sanctions, you're missing the bigger picture. Happening in Switzerland could reshape how gold moves around the world and who controls it. To understand why America is doing this, we need to look at what's happening in Switzerland and what role these refineries play in the global gold market. Over the past 18 months, the U.S. Treasury Department, the Office of Foreign Assets Control, and diplomatic channels have steadily increased communication with Swiss authorities and Switzerland's 4 major gold refineries: Valcambi, Pamp, Gore-Heraeus, and Metalor. These aren't household names, but together they handle the majority of global gold refining. The focus is specific, ensuring that gold sourced from sanctioned countries, conflict zones, or entities under U.S. restrictions does not flow through Swiss refineries into Western markets or onto the London Bullion Market Association's good delivery list. This matters more than it might sound. LBMA accreditation is the global standard for gold bar quality and traceability. It's essentially a passport that allows gold to move freely across international markets, accepted by central banks, institutional investors, and major dealers. Without it, it becomes harder to sell, harder to vault, and harder to use as collateral. Switzerland's refineries don't just process gold. They legitimize it. U.S. officials have specifically raised concerns about gold originating from Russia, Venezuela, certain African nations finding its way into the global supply chain. The concern isn't theoretical. Physical gold, unlike financial assets, can be moved discreetly, melted down, and re-refined with new documentation. Bar that originates in a sanctioned country can be transformed into one that appears clean. At the same time, Swiss refineries have reported rising demand from Asian and Middle Eastern buyers, many of whom are far less concerned with Western sourcing standards than their European or American counterparts. Here's the key detail. The U.S. isn't imposing formal sanctions on Switzerland. It's applying pressure through regulatory expectations, compliance costs, and reputational risk. The message is clear without being explicit. But here's what makes this complicated. Switzerland isn't violating any international law, so why is the U.S. pushing so hard? To answer that, we need to understand how Switzerland became the world's gold refining hub in the first place, and why that position gives them power. Most people don't realize. Switzerland's dominance in gold refining didn't happen by accident. After World War II, Switzerland's neutrality, political stability, and deep expertise in precision manufacturing made it the ideal location for gold refineries, serving a world recovering from conflict. While much of Europe rebuilt, Switzerland remained untouched, trusted, and strategically positioned between East and West. During the Cold War, that neutrality became an asset. Switzerland became the intermediary, a trusted neutral party, where gold from the Soviet Union, South Africa, politically sensitive sources could be refined and sold into Western markets without direct political friction. Soviet gold couldn't easily enter London or New York, but it could move through Zurich. South African gold, produced under apartheid, faced similar barriers. Switzerland provided the solution. By the 1980s and 90s, Swiss refineries had built unmatched technical expertise. They mastered the ability to refine gold to the 0.9999 fineness standard, the level of purity preferred by central banks and institutional investors. This wasn't just about metallurgy, it was about trust. A Swiss refined bar carried a reputation for quality that few others could match. Then came the 2000s. China and India's gold demand exploded. Swiss refineries scaled rapidly to meet it, becoming the critical link between mine production, scrap recycling, and consumer markets. They didn't just refine gold, they facilitated its global movement, connecting supply in one hemisphere with demand in another. But then the world entered the sanctions era. After 2014, following Russia's annexation of Crimea, the United States and European Union imposed sweeping sanctions on Russian entities, including restrictions on gold exports. Those restrictions tightened dramatically after 2022 with the full-scale invasion of Ukraine. Russian gold was effectively banned from Western markets. But here's the problem. Physical gold, unlike financial assets, can be moved, melted, and re-refined. A Russian-origin gold bar can be sent to a refinery, melted down and recast with new stamps, new serial numbers, and new documentation. If that refinery is LBMA accredited, the gold is now considered clean in the eyes of the market. It can be sold, vaulted, and traded without restriction. This is the vulnerability the United States is now trying to close. Switzerland's refineries, built to serve a neutral role in a divided world, become a potential bypass around the financial architecture that America relies on to enforce its foreign policy. And this is where the strategic problem begins. Because in a world where financial sanctions are America's most powerful tool, gold offers a way around them. So the real question isn't whether Swiss refineries are breaking the rules. It's whether the rules are still fit for purpose in a global gold market that's changing faster than regulations can keep up. The United States' pressure on Switzerland's gold market isn't primarily about stopping Russian gold. It's about maintaining control over the infrastructure that determines which gold is legitimate and which isn't. In a world where central banks are buying gold at the fastest pace in decades, and where trust in the US dollar as the sole reserve asset is quietly eroding, the ability to define what counts as good delivery gold is a form of power. Kevin WARSH has pointed out that the international monetary system is entering a period of structural transition, one where multiple reserve assets, dollars, euros, gold, and potentially digital currencies, will coexist. In that environment, controlling the certification and movement of physical gold becomes strategically important. Here's the hidden dynamic most observers miss. If Russian, Chinese, or Middle Eastern gold can be refined in Switzerland, stamped with LBMA-approved markings, sold into global markets without friction, then sanctioned countries can effectively bypass financial restrictions. They can convert gold into hard currency and fund state activities, despite being locked out of the dollar-based financial system. From the American perspective, this undermines sanctions' effectiveness. Financial sanctions have become the primary tool of economic statecraft, more powerful than military action in many cases. But sanctions only work if there aren't easy alternatives. Gold, when refined through the Swiss system, provides exactly that alternative. Consider the mathematics. Russia produces roughly 300 tons of gold annually. At current prices, represents approximately $20 billion in potential revenue. If that gold can be refined in Switzerland, certified as LBMA good delivery, and sold into Asian markets, Russia retains access to hard currency despite Western sanctions. The same logic applies to other sanctioned entities. But there's a deeper strategic issue. The United States doesn't refine significant amounts of gold domestically. American gold mining companies typically send their product to refineries in Canada, Switzerland, or other processing centers. The U.S. financial system relies on London and Switzerland to provide refining, vaulting, and market-making infrastructure for physical gold. If that infrastructure becomes politically neutral, or worse, tilted toward non-Western buyers, the United States loses leverage over gold flows. This isn't theoretical. It's already happening. China has been quietly building its own refining capacity and gold exchange infrastructure in Shanghai. The Shanghai Gold Exchange now handles more physical gold settlement than London in certain categories. Chinese refineries are expanding capacity and building relationships with mining companies across Africa, South America, and Central Asia. Their message is simple. We offer processing without political conditions. Meanwhile, refineries in the United Arab Emirates, India, and Turkey are also expanding. They're positioning themselves as alternatives to Swiss processing, particularly for gold originating from countries facing Western sanctions or political scrutiny. If Swiss refineries begin prioritizing Asian and Middle Eastern clients over Western compliance standards, the center of gravity in the gold market shifts. Gold refined under different standards would trade in different markets, creating parallel systems. Western certified gold for institutional investors, non-Western gold for everyone else. This fragmentation would reduce American influence over global gold flows. More importantly, it would signal that the Western financial infrastructure, SWIFT, LBMA, dollar clearing isn't the only game in town. Countries already concerned about dollar dependence would see this as confirmation that alternatives exist. Kevin Warsh's analysis becomes crucial here. He argues that we're witnessing a structural transition of the monetary system, just temporary market volatility. In his view, central banks are diversifying away from pure dollar dependence toward a more multipolar reserve structure. Gold plays a central role in that transition because it's the one reserve asset that doesn't depend on any single country's fiscal policy or political decisions. The United States is applying pressure on Switzerland now to prevent this shift from accelerating. If Swiss refineries maintain strict Western compliance standards, the global gold market remains unified under Western rules. If they don't, alternative infrastructure becomes more attractive and the fragmentation accelerates. This explains the timing. The pressure isn't responding to a specific violation or crisis. A preemptive move designed to maintain control over gold market infrastructure before that control is challenged more directly. The stakes are larger than they appear. This isn't about one country or one refinery. It's about whether the West can maintain control over the rules of the global gold market, or whether those rules are about to be rewritten. And the consequences of getting this wrong go far beyond Switzerland, because what happens to Swiss gold affects everyone from central banks to individual investors. If the United States successfully tightens control over Swiss gold refining standards, the immediate consequence is higher compliance costs and slower processing times for refineries, which could push some gold flows toward less regulated markets. That might sound technical, but it has profound real-world effects. For central banks accumulating gold, the priority is reliability and liquidity. They want bars that are universally accepted, easily traded, and recognized by other institutions. Swiss refineries become harder to work with due to American compliance demands, requiring extensive documentation, longer processing times, higher fees. Some buyers may shift to Asian refineries or accept lower standards rather than deal with the complexity. This creates the possibility of a fragmented gold market. On one side, Western certified, LBMA-approved gold that meets strict sourcing standards but comes with higher costs and regulatory overhead. On the other side, gold refined in China, the UAE, or India, where standards are less stringent but access is faster and easier. A two-tier gold market would fundamentally change how the metal trades. It would reduce overall liquidity, widen bid-ask spreads, and create price discrepancies between regions. Gold refined under Western standards might trade at a premium to gold refined elsewhere, reflecting the additional compliance costs and certification value. For investors, this matters enormously. Gold's value as a reserve asset depends on its universal acceptability. If you own gold, you want to know it can be sold anywhere, anytime, without questions about its legitimacy or origin. Market fragmentation introduces uncertainty. Gold is truly liquid. Which standards will be accepted in 10 years? Where should gold be stored and in what form? There's also a credibility issue that extends beyond gold itself. Just happened. If the United States is seen as weaponizing gold market infrastructure the same way it has weaponized the dollar-based financial system, it may accelerate the very diversification it's trying to prevent. Countries already concerned about dollar dominance may interpret this as confirmation that relying on Western-controlled infrastructure, whether it's SWIFT, LBMA, or dollar clearing, creates strategic vulnerability. The message becomes clear. If you depend on Western financial infrastructure, that infrastructure can be turned against you when geopolitical interests conflict. This perception could drive accelerated development of alternative systems. Central banks might diversify not just their reserve holdings, but also their refining, storage, and trading relationships. Instead of concentrating gold activities in London and Zurich, spread operations across multiple regions to reduce dependence on any single system. The credibility problem is particularly acute because Switzerland isn't even formally allied with the United States. Switzerland is neutral, cooperates when interests align, but it also values independence, and has historically resisted external pressure when that pressure conflicts with its commercial interests or neutral status. If the United States pushes too hard, Switzerland may choose to prioritize its commercial relationships with Asia and the Middle East over Washington's preferences. Swiss refineries generate significant revenue from Asian clients who are less concerned with Western compliance standards and more focused on processing capacity and speed. Such a shift would represent a significant geopolitical realignment. Switzerland moving closer to Asian commercial partners and further from American regulatory preferences would signal that even traditionally Western-aligned neutral countries see value in maintaining independence from American financial oversight. The implications extend to individual investors and institutional holders. They face new uncertainties about which gold is considered good and where it should be held. Will LBMA standards remain the global benchmark, or will regional standards emerge? Should gold be stored in traditional centers like London and Zurich, or distributed across multiple jurisdictions to hedge against regulatory changes? These aren't abstract concerns. Central banks are already asking these questions. Some have begun diversifying storage locations, moving gold from traditional Western vaults to domestic storage or regional facilities. Others are establishing relationships with multiple refineries and certification systems. Rather than relying exclusively on Western infrastructure, the irony is striking. The United States is trying to prevent the fragmentation of the gold market and maintain Western control over gold flows. But the very act of applying pressure could trigger exactly the outcome it seeks to prevent. Demonstrating that Western infrastructure comes with political conditions, American actions may accelerate the development of alternative systems designed explicitly to operate outside Western oversight. So, what happens next? There are several possible scenarios, and each one leads to a different future for the global gold market. 4 scenarios emerge from this tension, each with distinct implications for how gold markets evolve over the next decade. Scenario 1. Switzerland complies. Market consolidates. Around Western standards in this outcome, Swiss refineries accept stricter American and European sourcing requirements, increase transparency around supply chains, and maintain LBMA accreditation under tighter rules. The cost would be significant: higher compliance expenses, potentially reduced throughput, and lost business from clients unwilling to meet Western standards. But the benefit would be clear: Swiss refineries retain their position as the world's trusted refining hub. Gold from questionable sources gets pushed to the margins of the market. Western investors and central banks continue relying on Swiss refined gold. The global gold market remains unified under Western standards, with LBMA certification continuing as the universal benchmark. This scenario preserves American influence over gold flows and maintains the existing infrastructure that has served Western financial interests for decades. It's clearly the outcome the United States prefers. Scenario 2. Switzerland balances, creates dual-standard Swiss refineries, could develop a 2-track system. One set of standards for Western clients: strict sourcing requirements, full transparency, extensive documentation. Another track for non-Western clients: less stringent requirements, faster processing, fewer questions asked. This approach allows Swiss refineries to serve both markets without completely losing business from either side. Western central banks and institutional investors get the compliance they require. Asian and Middle Eastern buyers get the efficiency they prefer. But this creates exactly the market fragmentation the United States wants to avoid. Gold refined under different standards would trade at different prices in different markets. Western certified gold might command a premium, while non-Western gold would trade at discounts in regional markets. Liquidity would fragment along geographical and regulatory lines. Scenario 3. Gold flows shift east, but fracture F American pressure becomes too onerous. Refineries in China, India, and the UAE could gain significant market share. These facilities are already expanding capacity and building relationships with mining companies worldwide. China's Shanghai Gold Exchange is increasingly used for physical settlement, particularly by Asian central banks and commercial buyers. Middle Eastern buyers, especially in the UAE and Turkey, prefer regional refining that doesn't require Western compliance documentation. If Swiss refineries lose their dominance due to regulatory burdens, the center of gravity in the gold market shifts eastward. Western certification becomes less relevant for large portions of global gold trade. A parallel, non-Western gold market emerges with its own standards, pricing mechanisms, and trading infrastructure. This scenario represents a fundamental realignment. Instead of one global gold market centered in London and Zurich, two distinct markets would emerge. Western and non-Western, each with different rules, different participants, and potentially different pricing. Scenario 4. Diplomatic resolution. Status quo holds the United States, and Switzerland might reach a quiet diplomatic agreement that changes little in practice. Symbolic increases in compliance, some enforcement actions for public consumption, no fundamental alteration in how Swiss refineries operate. This approach allows both sides to claim victory while avoiding disruptive market changes. American officials can point to increased Swiss cooperation on sanctions enforcement. Swiss refineries continue operating much as before, serving all clients with minimal additional restrictions. However, this outcome merely postpones resolution of the underlying tension between sanctions enforcement and market neutrality. The fundamental conflict between American strategic interests and Swiss commercial interests remains unaddressed. Each scenario carries different implications for gold pricing, liquidity, and market structure. In Scenario 1, maintains unified global pricing, but potentially at higher cost due to compliance requirements. Scenario 2 creates price differentials between certified and non-certified gold. Scenario 3 fragments the market entirely, with regional pricing and reduced overall liquidity. Scenario 4 maintains current conditions but with ongoing uncertainty. For investors, the choice of scenario determines critical questions. Which gold provides truly universal liquidity? Where should gold be stored? And what certification standards will matter in the future? Central banks face similar decisions about diversifying refining relationships, storage locations, and trading partnerships. Rather than concentrating all gold activities in traditional Western centers, many may hedge by establishing relationships with multiple refineries and certification systems. The outcome depends heavily on Switzerland's strategic choice and market demand patterns. Asian and Middle Eastern demand continues growing while Western demand stagnates. Swiss refineries may find non-Western clients more commercially attractive, regardless of American pressure. Kevin Warsh's analysis suggests Scenario 3 is increasingly likely without coordinated Western action to make compliance less burdensome while maintaining effectiveness. The next 12 to 24 months will determine which scenario plays out, and the choice Switzerland makes will reshape the gold market for decades. So where does that leave us? And what should investors and policymakers be watching? The hidden reason America is targeting Switzerland's gold market isn't about stopping gold trade. It's about preserving control over the infrastructure that defines legitimacy in a fragmenting global financial system. In an era where central banks are diversifying away from dollars, sanctions are becoming harder to enforce, gold is reclaiming its role as a strategic reserve asset. The ability to certify and move gold without friction is a form of power. Switzerland sits at the center of that system. What happens there matters not just for refineries or traders, for anyone holding gold as insurance against financial instability. Whether you own physical gold, gold mining stocks, or simply want to understand how the monetary system is evolving, the decisions being made in Zurich and Washington will affect you. Kevin Warsh's warning deserves attention. The international monetary system is changing, and the institutions we've relied on for decades may not be equipped for what comes next. The assumption that there will always be one global gold market, operating under consistent rules with universal pricing and seamless liquidity, may not hold. If the United States succeeds in tightening control over Swiss refining standards, the gold market remains Western-centered, at least for now. That success comes with costs, higher compliance burdens, slower processing, and the risk that non-Western alternatives become more attractive over time. If Switzerland resists American pressure, gold flows shift eastward toward refineries in China, India, and the Middle East. We may be witnessing the early stages of a parallel financial infrastructure that operates outside Western oversight. That infrastructure wouldn't just handle gold, it would extend to other commodities, currencies, and financial instruments. Either way, gold is no longer just a commodity priced by supply and demand fundamentals. It's becoming a battleground where questions of monetary sovereignty, financial independence, and geopolitical alignment play out through seemingly technical decisions about refining standards and certification processes. The next 12 to 24 months are critical. The choices Switzerland makes, the pressure America applies, and the alternatives that emerge will shape gold markets for the next generation. They'll also signal whether the Western-dominated financial system can adapt to a multipolar world, or whether that world will build around it. Anyone holding gold or considering it, the question isn't whether you should pay attention to what's happening in Switzerland. The question is whether you're prepared for a world where the rules governing gold, and money itself, are being rewritten in real time. The battle for control of the gold market is happening quietly, behind closed doors in Zurich and Washington. But the outcome will be anything but quiet.